Maranzarian. I'm from Premium Real Estate in Takapuna, and today I've got with me Glen Stanley from Supercity Mortgages. Hi, Glen.
Hi, Miriam. How are you?
I'm fantastic. Yourself?
Good. Yeah, top of the world, mate. Top of the world.
Now, Glen, you got a wealth of knowledge when it comes to providing insight into finance, and I just wondered if you've got anything that you'd like to share with us as far as what's going on in the market and what the advantages are at the moment, what the opportunities are.
Yeah, absolutely. Thank you for the opportunity. It's really nice to be here again. 2018 has really started with a big bang. We had a bit of a stalled election, as you know, and that really made the property market ground very much to a halt tail end of last year. Midway through January, though, people got back off their hands again and really started getting out there looking. Banks haven't really made that too easy for a number of people. There's been a number of rules and regulations imposed on lenders, which have meant that applications which generally would have flown through with most banks are now getting stalled and shopped around. We're finding that the same application can be declined by one or two banks and approved by two or three others. So there really is a bit of a knack to presenting your application through in the right light. As I said, we've really seen a big spike in activity, but not so much in the new purchases and house sales market. A number of people have recognised, I guess, that the only way to move forward in light of a lot of these new restrictions is to potentially look to subdivide their existing property, or to maybe even buy new off plans, which is something that has been exempt from the Reserve Bank restrictions, meaning that people can borrow up to 90 or even 95% of the cost of a new build. On the back of a slow real estate market, the banks have had to fill their boots other ways, and so competition has been really quite fierce in the interest rate space, particularly in the short term. 1 year rates right now seem to be very much the sweet spot. We're getting offers very low fours, even sub 4% for a year. However, the longer term interest rates, things like 3, 4 and 5 years, continue to climb up to and over, in some cases, 6%. So there's a real incentive to go short, but with that comes quite a degree of risk. We don't know where the economy is going to be in 12 years.
Are we getting a different kind of buyer out there compared to what we have been in the last 3 years?
Absolutely. I'd say that a good 60 to 70% of my clients who have been approved by the bank for X amount have a conditional approval. That means that the bank is happy to lend them whatever it may be, $600,000, $700,000, $800,000, provided they obtain a valuation, or provided they obtain a building report, for example. Now, that's fine, all well and good. However, there's been a real spike in auctions as a method for selling properties, which has actually ruled a lot of these people out of the market. A lot of guys are not keen to go out and spend, $700,000, $800,000, $900,000 obtaining a valuation for a property that they truly don't know whether they're going to own or not. And so are in a very strong position to put a conditional offer forward, which is something that they can't do during an auction campaign. So a lot of people are sitting back, sitting on their hands, waiting for the auction to come and go, and hope that the property doesn't sell, so that they can then subsequently put in their conditional offer afterwards.
So with that in mind, is auction still the way to go, do you think? From a real estate point of view, it is, because properties are in the market at less time. But from a buyer's point of view, although the auction isn't successful on the day, it's selling afterwards. So is it still a bonus?
Indeed. I feel that vendors could attract more conditional interest if they didn't go to the auction room.
Right.
Now that said, there's no guarantees with a conditional offer. And so, it could be that you take an offer of 1.2 million for your property subject to evaluation that then comes in at 1.1 and the deal falls over. You're back to square one. Of course, an auction does capture the maximum number of unconditional buyers on any given day. But as I said, it could be that you have half a dozen unconditional buyers prepared to pay $1 million and one conditional buyer prepared to pay 1.1. So you are missing out on a number of opportunities there by going that route.
So, in that respect, something like a set date or a tender process can still be conditional, but
indeed, absolutely. Tender, I think, is largely underrated. I know off the top of my head of a number of buyers who would far sooner visit a property going to tender, who literally just skim over any options. They've just given up hope, having missed out too many times. An indicative price range would be useful. Of course, an auction really does give us accurate, on-the-pulse information as to what a property is worth, whereas the tender type process is almost a blind auction. We don't know what you're up against.
Yeah.
So one person may see value at 800, another may see value at 1.2. You just don't know.
You're still working in favour of the vendor.
Indeed.
You're still getting the best price for it.
Absolutely.
So, in the next few months, do you think there's going to be opportunities out there for certain types of buyers?
Absolutely. I've seen a big spike in first home buyers, possibly on the back of the new Labour-led government. There's been more and more talk of you can get out there and you can do this. A lot of guys are realising that the KiwiSaver scheme that they started 5-6 years ago is now worth $40,000 or something.
Right.
Money that they didn't really see going out, they didn't really miss, but they've now got sufficient money to put down a deposit on a property. Individual applicants, we see a lot of. It's very difficult to get a bank to approve a loan sufficient to purchase properties here on the shore at least, where we're dealing with one earner. So young families, where she may be still off work, maternity leave, that sort of thing, is very, very difficult. But two young professional applicants earning $50,000-$60,000 a year, certainly in a position to be buying up. And as I said, with a number of people now exploring the concept of subdividing and chopping their sections up into smaller bite-sized chunks, I think we're going to see that housing boom, the building boom, finally start to take place.
Sounds appealing.
It does. I mean, there's been a housing shortage for, we all know, for a number of years. Other restrictions imposed by the Reserve Bank and the government, such as a ban on overseas investors, will open up those opportunities in due course. I think that we're probably going to see the divide between $600,000, $700,000, $800,000 houses and $1.5 million plus properties get even larger, as those who are already on the property ladder, possibly onto their second or third home, start to buy for more and more and more and more, and yet a number of developers trying to pitch their product, their new houses in that first home buyer space.
Now, I am interviewing Stanley next week about, I'm just going to talk about the Bright Line test. Now, that's about to change, and it's just waiting for that go-ahead.
Yes.
How is that going to affect the finance side of things?
Yeah, interesting point. I mean, for those who aren't aware, the Bright Line test has been in place for a number of years. Currently, properties that are not occupied by the owner, i.e. an investor property or a rented property, sold within 2 years is subject to effectively tax on the capital gains. It's taxed at your own personal tax rate. But effectively, those rules are now being extended out to 5 years, meaning that anyone considering buying an investment property needs to think long and hard about how long they intend to hold it. Now, in terms of my clientele, the majority tend to buy a property for the long term. Obviously, things like interest rate increases may cause affordability issues later on. And again, there's something to be mindful of. I think we're still going to see people buying investment properties, but perhaps instead of fixing for those very, very low 1 and 2 year interest rates, they might start to consider fixing for 4 or 5 years to safeguard that investment. You may find that in turn increases the rents that we see. I know that that's already happening in places like Wellington and Christchurch. But yeah, there are traders out there, investors who buy properties, spend $50,000 doing them up and then sell them for a large capital gain. I think that we're going to see fewer and fewer of those. Currently, they probably buy it, do it up, rent it out for another year and a half, and then sell it once it's out of that threshold. But yeah, there could be some opportunities again for those first home buyers looking to get on the property ladder and buy their own.
Well, thank you, Glenn.
It's a pleasure.
It's been very enlightening, and I look forward to catching up again.
Indeed. Thank you very much.